Good afternoon. I'm David McKinley. I'm the president of McKinley Carter Services, and I'm pleased to welcome you to another of our FYI for your investment events. Webinars are a new addition to this effort, and we hope you find it worthwhile. As FYIs are part of our ongoing communication effort for clients, webinars, updates, and other media. Please let us know what topics you'd like to see us address in the future. Today, we'll focus on the fundamentals of investing and planning for retirement, but don't hesitate to post questions on other related topics. In fact, I'll tell you now that on the right-hand side of your screen, there'll be a little area. If you can't see it yet, you should be able to see it soon. There'll be a little question mark, and you can click that and then chat a question to us at any point during this afternoon session. What we'll do is we'll try to aggregate them all and answer them as many as we can at the end of the session. So what brings us here today? So as we think about an extraordinary situation originally lit up by COVID-19, social distancing and stay-at-home orders, an abrupt and overwhelming economic downturn, 30 million people on unemployment, about 20% of our workforce. It's an extraordinary time in our history. We thought it would be an appropriate time for us to spend a little time talking to the thousands of participants that we have across our retirement plans. Today, what we'll address is ideas on how to make the most of your retirement plan and investment volatility now and in the future. Let's see if we can advance our slides. There are a couple things we need to do, and I want to work our way through some introductions. So a couple things, we are an SEC registered firm, and so although this is not a solicitation, and the performance figures that you may very well see as we work our way through shouldn't be deemed to be representative of a composite of any of our portfolios. But if you ever choose to, in fact, work with us, we'll just provide you a standard disclosure form. At any rate, let's keep moving. I want to introduce John Slicer. John is joining me today. He's a financial strategist with 12 or 13 years of experience, valuable credentials like the CRPS, Chartered Retirement Plan Specialist, but most importantly, he's as enthusiastic and passionate as I am about care for ERISA plans, sponsors, and what brings us here today, you, plan participants. But he and I don't work alone in serving clients, and although there are some 40 employees that make up the entire firm, we have offices in West Virginia, PA, Pennsylvania, and Maryland. Today, we're going to focus on the retirement plan services team. Overall, we are among the top 2 or 3% of all advisory firms in the country as far as size, and in fact, collectively have more than 500 years of advisory experience. We currently manage over $1 billion in investment assets for wealth management, retirement plan services, and nonprofit clients, and have been recognized by CNBC as one of the 100 best firms in the country, and recognized by an industry trade publication as one of the 75 best employers of advisors in the country. But more specifically today, around our retirement plan services team. 20 years ago, it's hard to believe, we launched this group because we knew there were certain things that we wanted to do for our communities. We wanted to be able to bring to the masses, if you will, investment tools and education and processes that help people save and invest for retirement. Our core business, if you will, is wealth management, but we cannot offer wealth management services to all. It's not cost effective and very difficult to do, but our retirement plan services division is a wonderful platform, and we've been able to touch literally thousands and thousands of people over the years. So with that, we'll move on. Today, we're here to address your concerns and invite questions. I said earlier about a way that you can post them. If you haven't yet gotten instructions, you will get them soon, and we welcome those. John Slicer, I hand you the baton, so to speak.
Thank you, David, and good evening, ladies and gentlemen. My purpose tonight over the next 20 minutes is twofold. Firstly, I hope to relieve some of your anxiety about how this pandemic and the resulting economic slowdown might affect your long-term financial comfort. And second, I want to encourage you tonight and motivate you to be more aware and more intentional about taking care of your personal financial health, specifically around retirement planning. So here we are, some 6 weeks into self-quarantine. Thousands of people are mourning the loss of family and friends, the complete closure of businesses in some industries, and while others struggling just to hang on. People are concerned. People are worried. Some are downright panicked about their personal financial situation. So I might ask, what is the typical American to do at this point to protect her retirement savings, much of which is invested in companies around the planet whose stock values have been swinging wildly since late February? Is this crisis different? Is this the one that's going to be our permanent undoing? Is the global economy going to be forever damaged, and along with it, our retirement savings and our future financial comfort? Well, my answer, along with the answer of my colleagues, is simply no. Now, I'll be the first to say that there are no facts about the future. Nobody has a crystal ball, right? So what makes me, along with my colleagues, and actually thousands of others around the globe, so optimistic in the face of COVID-19? Well, let's look back in time a little bit and remember what this country and others around the planet have overcome. We've made it through 2 world wars, a war in Vietnam, a war in Korea. We defeated a group of madmen in Germany who slaughtered over 6 million humans. We pushed through when our president and the greatest civil rights leader were assassinated. We rallied together when another group of madmen murdered almost 3,000 Americans by hijacking our own commercial airplanes. We've come through a dozen economic recessions since World War II. We made it past the tech investment mania of the early 2000s when stock values plummeted. We overcame corrupt mortgage practices in 2007 and 8, which also caused stock values to temporarily spiral down 49%. But if you are thinking that none of these events are truly like the one we're facing now, then let's not forget that polio once paralyzed or killed 500,000 people annually. But now, due to scientific advancements, there are fewer than 200 global cases each year. And lastly, our country and many others on this earth have continually advanced in the areas of medicine, science, and technology for the past 102 years, when at that time, 22 million people died in the influenza pandemic of 1918. So you might say that in spite of all of this, yes, or because of all of this, my colleagues and I do have faith in the future. And from the long-term investor's perspective, and that's you and me, because we are long-term investors, it's the only view that aligns with history. As my teacher, Nick Murray, is fond of saying, optimism is the only realism. We have to decide on which side of the line we stand. That of the pessimist who thinks the world is going to suffer irreparable damage upon every crisis that comes our way, or that of the optimist who feels that no challenge is too great to overcome. So what do? We do the same things that the optimistic, rational, long-term investor has always done. COVID-19 doesn't change that one bit. For those of you who are already doing these things, the next 15 minutes will serve as a confirmation that you're still doing the right things. And for those of you who are not yet doing these things, listen closely. And if it all sounds too overwhelming to do by yourself, we are here. Remember that. My colleagues and I are here. All you have to do is ask us for help. I'll venture a guess that everyone on this call, including me, has an identical wish. And it's this: we all wish to have an income that we never outlive. We all wish to have a monthly inflow of cash to buy the things that we need and want, even if we live to 110. Now, I intentionally used the word wish there to express this common trait among us, because to me, wishing is a passive activity, whereas planning, which is what we're going to talk about today, is an action. It's an action with motion to it and meaning behind it. Merely wishing that I will voluntarily be able to leave the workforce at age 65 and be financially comfortable for the rest of my life is, well, that probably has a very low probability of happening. Wishing has never brought much to me, I'll admit. However, the good news is, even with the simplest date-specific, dollar-specific plan of disciplined investing and of patience to allow the plan to work over decades, even during times of disruption like now, then we shift from the fantasy of wishing for lifelong financial comfort to the strong possibility of financial comfort. So, what are these 4 things that we can all do? Let's start here. Nothing great has ever been accomplished without a vision, not without a written plan. We know the overall vision. I said it earlier. It's an income that we never outlive. The details of your goal aren't going to look like everybody else's, but what I want to do right now is give you an example of what I mean by a date-specific, dollar-specific goal. So listen to this. When Michael was 35, he realized that maybe he needed to start planning if he wanted to have a realistic chance of living comfortably without a paycheck for the next 20 to 30 years from his 60s and beyond. So he sat down one weekend and he wrote out the following. By age 65, Michael wants to have built a retirement portfolio that will support a $3,500 monthly withdrawal. And each year thereafter, he wants his withdrawal amount to increase at least by the rate of inflation, because he understands that $3,500 when he's 95 will purchase a lot less than it will when he's 65. Also at age 65, Michael plans to apply for his Medicare health benefit, retire from his job, and go to work for a nonprofit organization he's been involved with. He thinks he'll work maybe 2-3 days a week. He'll be paid a fraction of what he earned in his profession, but that's okay because, well, he's not doing it because he needs to. He'll be working because he wants to, because he shares a passion for this organization's mission, and it's something that he'll enjoy. With his newly freed up hours, Michael sees himself spending more time with grandkids, with friends, traveling a little bit more. He's also planning on delaying his Social Security benefit at least until he's age 68, because he's read that the dollar amount we receive from Social Security, it actually grows in dollars each month we delay starting the payments. And lastly, his investment strategy will include a well-diversified portfolio of approximately 80% stocks, 20% bonds. He'll keep 1 to 2 years of living expenses in an FDIC-insured high-interest savings account, because he's learned that historically, stocks have temporarily dipped an average of 30% every 5 to 6 years. And with that cash reserve set aside, he'll be able to weather those temporary dips, covering his basic living expenses without having to sell significant amounts of stocks or bonds during the periods when they temporarily drop in value. Now that is an example of a date-specific, dollar-specific goal. That's our starting point. So now what? Well, now we get to the business of drafting a plan to support those goals. Now that plan has to be it has to have some reasonable mathematical probability. Notice I didn't say guarantee, but a reasonable probability of getting you where you want to be. So this is where we're looking at, how much have you already saved? How much are you contributing to your investments monthly? How much is your employer contributing? What's your stock bond investment mix? How much growth do you need from your investments? And especially, how much time do you have to hit your target? I'm going to show you some numbers now. And there's a lot of ways I could have gone with numbers, but I've chosen to emphasize the powerful effect of compound growth over different periods of time. And what I hope these examples do for you is get you a little excited, light a fire under you, to take a really hard look at what you've saved thus far, how much you're saving yearly, and how much time you have left. So let's take a look at these. We'll go back to my imaginary friend Michael, and let me direct your attention, as there are a lot of numbers here. In this particular chart, he's starting saving at age 26. He's starting out at a salary of $35,000 a year. Now, shift your eyes over to the green box and you'll see that we have some assumptions to this particular illustration. We're going to assume that Michael's salary is going to increase each year as he progresses through his career. In this case, I have accelerated his salary by 2% a year. Now let's look at his savings rates. In his 20s, he's going to save 10% of his gross salary every year into his 401k or his 403b, whatever plan that's offered. In his 30s, he's going to double up on that, 20%. In his 40s, well, now, the kids are a little bit older, their expenses are a little bit higher, whatever. He doesn't want to, but he's going to back off that deferral to 15% just so he can have a little more cash flow in the household. But then when he hits 50, he's going to ramp it back up to 20 for the home stretch to his mid-60s. And the final assumption in this example is a 6% annual return on investment. So let me point out two things before we get to the answer, or the final calculation, I should say. Inside the red brackets, that's about 12 years of time. And that's how many years it takes Michael to get from $0 to about $100,000, 12 years. But then look what happens after that. It takes only somewhere between 6 and 7 years for him to build the next $100,000. This is the magic of compound growth, if you will. The more money you have, the more money it can grow over long periods of time. Bottom line, by age 65, assuming all of these variables, Michael ends up with $1.1 million. So that is a period of about 40 years of consistent saving and investing. So what happens if Michael doesn't start until age 36? Well, instinctively we know it's going to be less. Let's quickly take a look. The variables in the green box, those are exactly the same. The salary from the previous chart is the same. It's higher because now he's 36, he's earning $42,000. But because he delayed 10 years of savings, by age 65, his nest egg grows to only $665,000. One more example, starting really late, age 46, his salary is higher, $52,000, same as in the previous examples. The variables on the right in the green box are exactly the same, but at age 65, with only about 19 years of savings, he accumulates only $349,000. So the web is full of what they call, just if you search retirement income calculators, there's a lot of them out there. And in fact, your 401k website probably has retirement income calculators. I know some of the record keepers have really, really powerful ones. If you don't know where yours are, call us. We'll help you find them. We'll point you in the right direction. So thing number 3. We know there are things in our lives that we cannot control, but there are also things that we can control. We can't control that there's a virus spreading across our planet right now. We cannot control the volatility of bond and equity prices, and we cannot control the media outlets who seem to scream every day that the end of the world is nigh and that we should be very fearful. We can't control those things, but we can control how we respond to them. And here's what I have to say about that. The point is that your investment plan should not be built upon nor altered because of media headlines. Your investment plan should be built to support your goals, period. And if your goals are not significantly changing, then your plan should not be changing. To say it another way, even in the face of turmoil, doing nothing to your investment portfolio is exactly the right thing to do. What else can we control? Well, when it comes to your employer-sponsored retirement plan, your 401k, your 403b, there are several things that you can be doing. Number one, keep making your contributions, even in times of disruption like now. Here's why. When stock prices are down, that's actually a good thing for people still in the accumulation phase because, of course, we're buying more shares of stock at deeply discounted prices, prices you are likely never to see again. We are likely never to see again prices that we saw in 2008 when the market was down 49%. And how I wish I could go back in time and scoop up a whole bunch of some of the great companies of the world at those prices. When we're in it, we think it's the end and we're fearful about continuing our investment program. But the point is that we shouldn't be, because we're buying more shares, lower prices, and this too shall pass. Number two, increase your contribution over time. Ask yourself, would changing your contribution from, say, 5% to 6 or 7 really be that painful? Maybe, maybe not, but I tell you what, that same small increase could significantly grow your retirement account over time. Remember the power of compound growth we looked at a moment ago. Third, make sure you are receiving all the free money that your retirement plan offers. If your plan offers a match, and not all of them do, but if yours does, don't ignore that free money. I've seen it happen. I enroll participants every month across lots of different plans. I clearly explain to them, if you put in, for example, 5% of your own pay, your employer will give you a 4% bonus, if you will, the 4% free money. Now you can't spend it, you can't take it home, it goes into your retirement account. It's yours to keep forever, and yet still some people don't do that. So don't leave that free money on the table. Number 4, what's your stock bond allocation? In most retirement plans, not all, but most, you have full control over that. The question is the allocation likely to produce the return on investment that your plan needs? If not, change it. If you don't know how, or if you don't know how to check it, call us. We'll help you do that. And number 5, above all, don't let the media headlines panic you into selling your investments. I hear it all the time, especially in times like this, in these crises. I hear it from 401k participants I meet with. They say stocks, stocks are too risky now. I can't take it anymore. I'm going to move my money to the bonds or the stable value, the money market. If your goal is to have an income that you never outlive, and that is your goal, then the exact opposite is true. And why is that? Because stocks, not bonds, are the asset class that has consistently outpaced inflation, historically speaking. And when we are facing a potential 20 to 30-year retirement period, depending on our portfolio to provide an ever-increasing income to offset inflation, then we'd better have the preponderance of our portfolio in the asset class that historically has outpaced inflation. And that asset class is stocks. And finally, thing number 4. We have a saying in my firm, it's don't suffer in silence. Ask for help. If you are a participant in a retirement plan that gives you access to an advisor, take advantage of that. If McKinley Carter handles your employer's retirement plan, then you do have access to an advisor. We love what we do, and we love to help the plan participants, but you have to ask. That concludes my remarks. David and I are going to address any questions that have come through during my presentation. Feel free to stay, listen, or depart if you need to.
John, we have a question.
Yes.
Unfortunately, my company had to reduce the workforce and I lost my job. Is there any guidance you can share about access to my investment balances?
About access, yes. So recently, Congress passed what's called the CARES Act, C-A-R-E-S, the CARES Act, which allows retirement plan participants who qualify, I'll talk about that in a second, to take distributions from their retirement plans without IRS penalty. They also, again, if you qualify, if you have a current loan from your 401k plan, you can defer those loans until I think 2021, later in 2021, again, without penalty. To qualify, you have to either have been diagnosed with COVID-19, a spouse or dependent has to have been diagnosed, or more leniently, if you have been laid off, or if your hours have been reduced, or in some other way your financial, your cash inflow to the house has been reduced, then most likely you qualify. And it is a self-qualification standard. You do need to check with your employer because they do have the choice whether to opt in or opt out of those CARES Act provisions. If you have any questions, you know, again, call us. We can speak specifically to your situation.
Sorry about that. We do have another question. Is the worst of the market decline behind us? I'm turning 50 this year and I'm growing concerned about market volatility.
David, I'll let you take that one. Turn on your mic though.
Sorry about that. Yes, I'm happy to do this. So two things. One, tonight's session is, of course, about retirement plan participation, about saving and investing. I'm going to answer this question, but I'll just say that there's a longer webinar, more investment focused, that is archived on our website, mckinleycarter.com. We'll share that with you at the end of our session here, and I would encourage you to take a look at that. However, in the meantime, there was a significant decline in the market between February 19th and March 23rd. We actually believe that the bottom was put in the equity markets on March 23rd. And the reason we say that a couple-fold. One is that markets generally move in advance of things that are happening. And so, for example, when there was maximum fear, maximum uncertainty about where things were headed, markets were collapsing. And then as soon as we started to realize how things could work out and how things would play out over the long term, you actually saw the markets recover in a pretty meaningful way. In fact, the stock market is up 25 or 30% from the bottom. We believe the worst is behind us, but there's always the possibility that we could see a resurgence in virus, another round of closing of businesses and economies, so to speak, and that would extend the declines. Here's what I would say to you. It is incredibly important through good times and bad, and this is the point that John was trying to make earlier, is that you identify what is the appropriate asset allocation for your situation, implement it, and stick with it through thick and thin, so to speak. Some minor tweaking here and there, but it was very difficult to time the market. So long story short, we think the worst is behind us, and I just would encourage you to spend a little time thinking through your risk tolerance, your investment objectives, and identify an appropriate asset allocation. There are some wonderful tools on these websites that'll kind of help you, your record keeper website, that'll help you think through some of those things, and don't hesitate to reach out to one of our advisors. A relatively short conversation, maybe it could be as simple as a 15-minute phone conversation. We might be able to give you some answers to guide you down a path.
Do we have time for one more?
Sure, that's good.
All right, next question. At the company level, should our company opt out of the CARES Act changes for 401k if we have no participant that is a qualifying employee?
So you want me to take that, David?
Yes, please. Mm-hmm.
So that sounds like it's coming from a plan sponsor or somebody on the HR level who's probably also a participant in the 401k plan. I don't know of any reason why you would want to opt out. Number one, you don't know. You don't know. We can't see the future. We don't know if any of your employees may be diagnosed in the future, or one of their spouses or dependents. So, David, do you know of any reason why an employer would have an advantage to opting out of offering the CARES provisions to their employees? I don't.
The only thing that comes to my mind is there's a lot of things happening in our worlds today. Thinking about the busyness, so to speak, within an HR office. Is it worth the administration having to go through some amendments? My guess is it's relatively modest. I have not personally done this, but I suspect it is worth the time and effort. So I concur with your point, John. But I tell you, if you in fact are a sponsored representative, don't hesitate to reach out to the advisor with whom you work, and we'll talk through the situation and see if in fact it would be worthwhile to pursue. Heidi, any other questions?
No.
Okay. Well, John, any closing remarks from you?
Nothing in closing.
Okay. Well, we'll give everybody another minute or two to pose any final questions, but I'm going to take this opportunity to thank everyone for joining us today, sharing our enthusiasm for making the most of your planned participation. Our enthusiasm is translated through our commitment. Essentially, our mantra, if you will, is to investing in a good life. And we want to make sure that we help each of our participants do just that now and for many years into the future. So to that end, if you have any questions or concerns that were not addressed today, please don't hesitate to shoot us an email or give us a call. In fact, perfect. The slide is on your screen. Visit our website, McKinleyCarter.com. Visit your record keeper website. Record keeper would be, for example, Empower, Alaris, on down the line of the different firms that we use with our various retirement plan clients. There are some wonderful tools and contacts that can help there, but we are here to help you as well. All of our advisors are working from home, but thankfully years ago we invested significant dollars in the IT necessary so that people could in fact work from wherever they need to be, in this case home. And so we're working Monday through Friday and serving the needs of clients, often doing virtual consultations, anything from a 15-minute conversation to a 2-hour or more discussion. So don't hesitate to reach out to us. In about an hour, you're going to receive a follow-up email that'll include a link to a short video. I think it's a minute long, that'll describe about how we work with clients. Don't hesitate to take a look at that. If you have an interest, we'd welcome a conversation with you. Again, I'll offer up our phone number and our website address and our email. Thank you very much for joining us today. We hope our conversation was helpful.
Thanks, everyone.